Hey Shane, how's it going?
Kyle, it is going, dude. I'm not annoyed anymore. I'm flabbergasted. Uh, Maybe
Eh,
still with a touch of annoyance. I can't believe this market just won't go down. I don't know who's buying. I don't know why they're buying it. But they are, and it seems like just relentless buyers. I mean, even this morning, market tried to drop. We were down, I don't know, 1% or something to open, and we are now up 77 basis points. I mean, the markets are still down 0.5% for the day, but they should, dude, when the jobs numbers came out yesterday, and then inflation PPI came out this morning, the market should have been down 3 or 4% over the past couple of days. But I don't know. They're Twilight Zone, Neverland, all these different fantastical places, I think is where the market is living right now. I just don't know how anybody still has any money to buy any stocks with. That's what really blows my mind. I don't
Yeah,
know. How are you?
it same. I'm sitting here, and if I just look at a chart, I'm thinking this is bullish. Go buy everything.
Yeah.
But I know what the fundamentals are, and it just does not support getting bullish right now. So I'm scratching my head, and hopefully that changes soon. We'll see, but not making a lot of sense to me
Well,
right now.
it's going to change right when I get fully long, right when I put all my money in and I'm like, well, I don't know. Market's just going to keep going up. I might as well put my whole stack in long. That's when it'll crash. So
Yeah,
I'll keep you posted on when I do that. Right now, I still actually have two shorts in the PA that are paying. I'm short Meta and I'm short Wayfair. I've closed some of those, taken some profits off of them, but they're still, I don't know. Meta can't rally when the market rallies, and Wayfair same. It's coming down even though the market's rallying. And then I have one long in the PA, and that's Dede,
yeah.
the rideshare company out of China. So we'll get to a chart for that a little later. But we actually have a pretty deep deck here today, and I think all of it's relevant. We're gonna try and cover it pretty quickly. Um, but there's gonna be a few slides. So stay tuned, but let's get into it, man.
Sounds good. And for anyone watching, today is February 16th. This will likely post here late in the afternoon, so we'll see what the market actually closes at. But hope you guys enjoy this. Please like, subscribe, throw any questions or stocks you want us to cover in the comments section, and happy to do so. All right, Shane, let's go ahead and get into our deck here. So starting off as usual, just looking at the SPY ETF. So that is the ETF for the S&P 500. And man,
Hasn't changed much from last week.
yeah,
Just some sideways garbage.
I think, what I am seeing, we're still stuck at this key level. But again, if I remove that bias that's telling me there's nothing fundamentally supporting a bullish move, and I look at this, what I'm seeing is a nice consolidation here that looks like a flag. It's over your,
Yep.
shorter term moving averages. This is a spot where I'm thinking it's, if you're a trader, great to get in, but if we move over that, that really leaves me questioning what the long-term picture is, but still seeing little MACD turn a little bearish, but yeah, it's just a consolidation right here under a key level, so we'll see.
Inexplicably, man. I mean, that should be rolling over and dropping hard. That's what should be happening if you ask me, based on fundamentals and just everything else that I see out there. But yeah, it looks like it's consolidating for a rip higher, and I don't know why. I think if I drew the line on there, there's going to be some more resistance right around 430. So maybe it just wants to overshoot to 430 before ultimately, getting hit again. But um, I don't know, man. I mean, the higher it goes, the less likely we are to make a fresh low for the cycle. That said, I still won't be surprised to see later this year, GDP in the negative 3, 4, 5% range, and a full-on recession going on with a new drop of 20%. So
Mhm.
I think that's absolutely still in the cards looking at fundamentals, but the technical picture is different. And, for short-term trading, you got to trade the market you have, not the market you want. And so if you're a short-term trader and you're not looking at ways to go long here, it doesn't feel good to me to do that, but I think you have to be paying attention. So fundamentally, it's just a really ugly picture, though.
Yeah,
I don't know.
I
I don't
I
know what else to
agree
say.
with you, and I think this is where if you're a trader, you kind of have to just respect these short-term moving averages. we get under that, then yeah, we can start to talk about a short. But right now, the trend is going up on a short-term basis. Too soon to draw any conclusions on that one. So,
Yep.
and then Nasdaq the same, and I mean you've got names like Tesla's up 100% from the lows, just blows your mind.
Yeah.
Nvidia is another one too that at least Nvidia I believe in, but man, that stock it's just not stopping for anything, and that's a lot of what's pulling this up. But again, this is it broke that downtrend resistance line. Looks like it's just consolidating under a key level. If I'm trading this, I'm liking it long. But again, if we're looking at the fundamentals, even if you are long-term investing, manage the risk right now because
You know,
this is
I should.
where,
Oh, go ahead.
you can make a little extra, but you got to have your stops in. If you're right and this is the end and we're a bull market, great. But right now, you definitely got to be, managing that position.
I should have put a chart in here that would have shown the 10-year yield versus the Nasdaq. Maybe we'll look at that next week. But they're those are normally inversely correlated. So rates go down, Nasdaq goes up. Especially looking at the 10-year Treasury. Right now, they've been positively correlated for a while, and it doesn't make any sense at all. I do have a 10-year yield chart in here later. It looks like it's going higher. Nasdaq look like it's going higher. Those two things shouldn't both go higher together. It just doesn't make any sense logically or economically that the companies that need to borrow money at a higher rate to finance their growth um, would be bought. I mean, it doesn't add up. And I think that eventually, like I said, it'll be right around the time I finally relent and put all my personal account in the long side. But I think those things will resolve and they won't stay, inexplicably positively correlated for long. And it's going to break one way or the other. Either rates are going to have to go back down, or the Nasdaq's going to have to go back down. I'm not sure which. We'll see, but I know what I think will happen. It's just how long it can stay irrational longer than you can stay solvent, right? So you don't just
Yep.
keep betting against this thing, and lose your money just because you want to be Mr. Smarty Pants and you say, hey, fundamentally this and that. It's just a good way to lose a lot of money. So right now I'm taking smaller size trades, mostly staying away, selling lots of put options, trying to earn my 5 or 10% in a safe way, and it's really just flabbergasting.
Yeah.
So I don't know. That MACD should be dropping. It should be going red. This whole market should be, down back below the 200-day moving average, and it just isn't. And so nothing I can do about it but sit and wait.
Nope. So moving on, looking at oil. Oil on a short-term basis, right in here, it looks like it's getting tight and it wants to break higher. I've been saying that since back here, though, that it's a tough market to trade. I'd like to just wait for that confirmation, get a good close up over, I think, 82 a barrel. But you are seeing that there where they tried to push it down here, but we had that low in there around 72 that was set back at the start of the year, and then here again. So yeah, I think it could go higher from here, but what are your thoughts?
Yeah, I won't be surprised to see one more quick drop to 70 before it rips higher, but it does seem to be tightening up. Um, you know, I don't know why I feel this way, but I feel like a fake out on the like a bear trap, right? Like a fake breakdown, and then just a reversal to way higher and back towards like $100 a barrel. Like I don't know why I think that, but that's kind of what I see happening. And maybe it has something to do with the next slide we're about to see, which is the commitment of traders for oil. Um, but that's kind of my guess at what's going to happen here. I don't know.
Yep, I agree.
But it's just a guess. I don't really have any scientific backup for that.
Yep. And then here's the big one. So speculators, bearish on oil.
As
So
bearish
it,
as they've been since 2016. So just to be clear, for those of you who don't know what the commitment of traders is, you can get this data from the CBOE. You can go to their website. Certainly Bloomberg has it. Lots of providers put it out. Comes out on Tuesdays, or sorry, I think it comes out on Fridays, but as of Tuesday that week. So it's not a real time picture of positioning. But this just shows you the number of contracts in the futures market. So if you're a big enough trader in the futures market, they know whether you're a hedger or whether you're a speculator. And it's funny, like a lot of people misunderstand what smart money versus dumb money is in this situation. Um, and the dumb money in the futures market is the hedge funds. They're speculating on what the price is going to be. They have no economic interest in what the price of oil is going to be. The smart money in the options market for oil specifically, the smart money is ExxonMobil and Chevron, and their financial officers are out hedging their exposure, right? So if you're in the business of producing oil, what you want to do is you want to guarantee the price that you're going to get to sell that oil for. So the oil you're producing today, you might be selling in 2 weeks, 3 weeks, 4 weeks, 4 months. Um, and you'll have other oil that you're going to produce, in the coming months that needs to be sold at a future price. And that's what the futures market is really for, is for companies like ExxonMobil to go out and sell their barrels of oil at a price in the future. And the people who take the other side of that trade is generally hedge funds and other speculators who want to guess at what the price is going to be. So the speculators are the dumb money. They don't, they don't know as much about the market, as much about production numbers, as much about what's going to be the future production as the smart money, the guys at Exxon who actually see the oil flow coming out of the ground, and they know if it's speeding up or slowing down. They know if they're going to drill a new hole or close an existing one, or they know better. So when you see speculators in this chart, so just backing up one step, when you're trading large enough futures contracts in the market, you have to identify yourself as a speculator or a hedger, a smart money or dumb money. Like that is something that you have to do when you trade enough contracts. So you can isolate who is positioned in which ways. And what this shows is that the speculators, the hedge funds, the dumb money in this market, they are extremely bearish, and that is usually a contrarian indicator.
Hmm.
It wouldn't be weird for the hedgers to be short oil contracts. Like that wouldn't be weird. That's what they do, right? They
Yep.
sell oil in the future. So that's the standard. They should be short. Now,
And
it's really bullish if the hedgers, if ExxonMobil is for some reason long oil futures, oil's definitely going to go higher, right? Like
yeah.
that's almost a no-brainer every single time.
And the big thing here, I always laugh because I think as Wall Street bets, they were calling out after the whole GameStop saga, they were gonna, you know, get all the short squeezed on silver. And what they didn't understand, what people often don't understand, is that, like oil. Well, if it's at 120 a barrel and you're producing oil, that's a great price. So you want to lock that in. So you are going to be shorting the market to just hedge your inventory that you're going to be buying. So, you know, what if it goes up from there? Just, it's all good for them. They've locked in the price. They don't really care where it goes.
Yeah.
So those are the commercials, or the smart money.
Yeah. So it's just interesting that they're, the speculators here are as short as they've been since, 2016. I bet you if you go back and look at a chart of oil from 2016 when they were this bearish before, I bet it went up. Maybe I should have done that and put that chart here, but I'm pretty confident that's the case. So again, it's not like a one for one, like an immediate indicator, but I think overall, this indicates to me that the most likely path for crude oil is higher.
Agreed. And then here's the one thing that's putting the brakes on a lot of stuff. So this is the 10-year yield. And if you look at this, it looks bullish, which that means a higher cost of borrowing. And this almost looks like a breakout to me, but Shane, I know you drew this line here. What I'm looking at is this high right here. So
Yep.
once we close over just kind of the horizontal high, or the
Yep.
previous high, once we get over that, I think that off it goes. And I think that could be the catalyst that
Yep.
really takes the market down.
Yeah, I mean, if rates go back to 4.4, the Nasdaq has no business continuing to grind higher, none whatsoever. I
Hmm.
mean, Doesn't mean it won't or can't. It just doesn't have any business doing so. There's no fundamental economic reason why that should happen if rates are going to go back to 4.4. So, and rates do need to go back that high in order for the yield curve to uninvert itself, which eventually will happen. That's not going to be a bullish thing either. Just so you're clear, I mean, we look at the yield curve being inverted, but once it like uninverts itself, I mean, that's good in the long run. That's how it should be. Things just getting back to normal. But the fact that it already has inverted, and the spreads versus the tens minus twos or twos minus tens has been negative. Yeah, tens minus twos has been negative. It already says there's a recession coming. So you're not going to escape that by the yield curve uninverting itself. But this to
Nope.
me looks like rates are going higher in the 10-year market. And it looks like they're going higher in the 2-year market too. So the yield curve might stay negative for a while.
Yep. And then here's another one. So it looks like this is just a zoomed out view of what we were just looking at. But
Well, this is the tens versus twos. So you got the 2-year treasury in the orange line, and you can
uh,
see that it's getting ready to break out to a new high. The 10-year treasury is the blue line, and it is not getting ready to break out to a new high. It's got some work to do to get back to that high. So to me, it looks like the twos are still accelerating faster than the tens, and that's why at the bottom of the chart you see the white line is negative. Oh, I forgot to change that back to the rate. That's not supposed to say minus 100% on the right of that. That's supposed to say that red line is at 0. And the yield curve or the tens minus two spread, let's see, what do I got it at? US 10. It is currently, oh man, minus 81 basis points. So 10-year treasury minus 2-year treasury is negative 81 basis points. The low of the cycle was back in December, and that was at 84 minus 84 basis points. So I mean, it's as negative as it's been for the most part, and it looks like it's getting worse because the 2 years are accelerating higher at a faster rate than the 10 years. So there's a lot of work to do here to get us out of the negative yield spread or the inverted curve, however you want to say it. And all of this spells, just bad fundamental economics in our overall economy. So, yep, doesn't look good,
no.
especially for tech
And
stocks, especially for tech stocks.
yeah. Yep. And especially anything that's not pay a dividend gets hit
Yep.
real bad.
Or
Or
anything that doesn't have profits, which is what's been rallying. Like you just saw Roku last night. We didn't put the chart in here for Roku, but like stuff that doesn't make any money. How do
yeah,
they finance their business? I mean, if you don't have any profits, what's the only way that you can finance the expansion or the operating of your business? You have to borrow money. What
hmm
is the most important number for anybody who has to borrow money? The 10-year United States Treasury. That is what everything is based off of or factored from. And if that cost of money is going higher, you and you don't have profits, you can't generate the operating capital you need from your own business. You have to borrow it at those higher and higher rates. That means you have higher and higher interest payments for longer and longer. There's no reason the the price of that stock should go up. It's just
nope.
there's no fundamental reason for it. So that's why this stuff is so important.
Yeah. And then all that then carries over to the US dollar. So higher relative rates to the rest of the world attracts a lot of capital to the US or demand for dollars. And you're seeing that here. That has certainly not helped gold. It'll probably bring some other commodities down, but strong dollar, not good for stocks. And a big part of that is any international, customers, they're not going to be buying a whole lot of US stuff because their currency is weak compared to the dollar. And this is always, just as a reminder, this is compared to a basket of currencies. So relatively speaking, the dollar is getting stronger versus other currencies in the world.
Yeah, mostly versus the euro and the yen, and to a lesser degree the pound, I believe, last time I looked at the basket.
Yep.
But those three are the biggest factor. What's happening with those currencies versus the dollar? And as of this morning, you've got the Fed, yakking and talking about maybe hiking by 50 basis points because inflation seems to be reaccelerating. And the more they raise rates at the Fed, the more people are going to demand dollars. The more people demand dollars, the higher the value of the dollar. The higher the value of the dollar, the lower the stock price should be, all else equal. All else is never equal. But um, if the Fed goes from hiking by 25 basis points the past couple of meetings up to 50 basis points again in the next meeting, the dollar is going to explode higher. Interest rates are going to explode higher. And if the market knows what's good for it, they will sell stocks and they will drop. Um, because it's only a matter of time before that works itself out.
Hmm.
Time will tell what happens here, and we just have to kind of wait and see and be patient. But we'll get to inflation numbers here in a second, and you'll see why the Fed they're hardly even hawkish. They're like little tiny baby hawks. I mean, they've hiked rates as much as they've hiked them, but they're still like I don't know. It's like a crossbreed between a dove and a hawk. It makes me sick to my stomach that they haven't been able to kill inflation yet.
Yeah. So, yeah, the next thing, talking about bullish things, Bitcoin going up. And the biggest takeaway for me here is risk appetite. Bitcoin is a risk on asset. So that means that it usually gets bought up when people are ready to take on risk. They feel good about things. That's what this is telling me. It's pretty bullish, going higher, I guess. But
Going higher, MACD's ticking up. I don't know who has the money to be buying Bitcoin. I don't know where they're getting the money from. I don't know if they're like putting it on their credit card or taking out a home equity line of credit to buy Bitcoin. I don't know who's got the money for this with eggs costing what they cost. Like I don't understand it. It really bothers me. It doesn't make any sense. I mean, again, we're going to look at some, household credit data here in a few slides and I, people can't pay off their credit cards. They can't. They're increasing delinquencies on their car loans, but somehow they've got money to buy Bitcoin. I mean, I've been accumulating Bitcoin here and there. I'm buying like little tiny amounts. I mean, I'm talking like 1% of my crypto account value at a time, like pretty much weekly, just kind of averaging in. Because I do think that Bitcoin will go higher in the super long term. Doesn't mean it can't go back to 17,000 or 16,000 or even all the way back down to 13,800. I'm not making any big bold calls like that. If it does, I'd love to buy some at 13.8. Um, but for now, I think it's going to go higher. I don't know why. I have no economic or fundamental reason for that. If the dollar goes higher, that should make Bitcoin less valuable. If interest rates go higher, that should make Bitcoin less valuable. But, I mean, you look at these charts and you're like, well, trade the market you have, not the market you want. And I'm sorry, but it doesn't get to look much more bullish than this. I mean, we've been basing since June of last year. I don't know, this thing could shoot higher to 40,000 overnight. I mean, we've all seen it happen in the Bitcoin market. So to me, it's worth the risk, of putting like a few percent of my account over the course of a few weeks into Bitcoin and seeing if it runs up. I mean, it was over 25,000 today for the first time since August of last year. So uh, we'll see what happens, but that looks pretty bullish to me. I wouldn't go bet the mortgage money on it, but you know, I'm a trader. It's what I do. So I
yep,
got all this money sitting in my Coinbase account. Hasn't been doing anything for like a year. It's burning a hole in my pocket. So what the heck? We'll go buy some.
yep.
Maybe that's what we should do, Kyle. We should just go put all of our clients' money into dog money, Dogecoin and Shiba Inu and see what happens. Maybe that's what we need to do in order to, make money. I'm
Yeah.
joking. I'm not
Not
doing that.
not a bad idea. I just don't know what size handcuffs I wear. So I'll
Yeah.
get back to you on that one.
Get fitted for the handcuffs first, is what you're saying.
Well, let's turn over. You mentioned Dede, and what a beautiful chart here. So
Oh yeah. Excluding that weird misprice down to like 25 cents, whatever that weird candle that wick is. I don't know what that is. That it kind of sometimes happens in these over the counter stocks like Dede. China's economy is in a better place than ours. I know that sounds ridiculous to say, but just from a rate of change perspective, looking at the inflation and GDP numbers, um, China is in a position where GDP is growing and inflation is falling, and that is kind of a good place to be. Um, and so China's been catching a bid. I mean, all China stocks are down 80, 70, some 90% from their highs, a year and a half ago. Um, and so going up 20 or 30% doesn't even get them remotely close to even, right? They got a long ways to go to get back anywhere where they were a year and a half ago, 2 years ago. So they've been in a protracted bear market for a long time. And, I'm just finally seeing some setups that I like. And this is one of those setups where, this stock's been going up from $1 to $4. I mean, it's up like, is that 400%, 4x?
Yeah.
And then consolidated and went sideways and now trying to break out again today. So I bought some in my personal account this morning. Uh, it's not saying you should buy some. You got to do your own thing. I'm not giving you advice, but I'm telling you what I did, and maybe we'll check back next week and see how much money I lost.
Yeah.
But
And
maybe we'll
the,
see. Maybe I'll make some. I mean, honestly, if it goes up to back to $5, the recent high, I'll sell some. I'll probably sell half of my position, take the profits, and let the rest ride from there with a tight stop at like the 10-day moving average or something like that. But I mean, a run to five will make me 10%. Um, so whatever. I'm here to make money, not friends, man. So we'll see if it works.
yep. And the big thing I'm seeing there, you've got MACD was negative, turning positive,
Yep.
but then look at this. So here you had a consolidation, broke out, and then here I love seeing this. So it's moving wider, but then it's narrowing
Yep.
and then kind of tightens up, gets that breakout. You could definitely, I think, move right up into here. So maybe 550, $6 is the immediate move. I mean, years from
Yep.
now, who knows? But that's a classic great trade setup and it's above your averages. So I
Yeah,
like
so
that.
I bought it at like $4.40. I got my stop at $4.30, which is the lows of the day today. So if it goes below the lows of the day today, I will just exit and take a small loss. Um, and then tomorrow I'll move my stop to like that upward sloping purple line, and as long as it stays above that, I'll stay in. I'll probably cut half of it if it gets to $5, like right to the recent high, and I'll let the rest just ride with the 10-day moving average, which is the white line on this chart. Uh,
Yep.
that's the one I'll use for my trailing stop if it does actually break out and go to five or higher. So then we'll evaluate from there. But yeah, I think I'm a little early on this one, but I do like that the MACD is looking like it wants to curl higher, and we're getting a real breakout um, on the daily chart. So that's Dede.
Yep. And then here's one we just always hit on, but the 30-year rate right now ticking back up and similar to what we were looking at with the 10-year yield, kind of formed what we'd call a flag formation. Looks like it's getting ready to go higher and at 6.3%, I don't see people or they're not going to be racing to go buy a house. So
No.
that's not going to help the housing industry.
Nope, but it's going to help the Fed try and bring down inflation. So,
Yep.
yeah, I don't know. It's just an interesting thing to keep an eye on. I think rates will go higher. I think 7 is probably as high as they're going to go for a while because that really does crush demand for for housing.
Yep.
So 7 is kind of the upward target from here. But yeah, probably bounce between 6 and 7% for a while would be my guess, or choosing a direction one way or the other.
Yep. And then Shane, you brought this one. Household expected income growth. We're seeing it go down. Doesn't surprise me one bit.
Not
Um,
just down though. Largest 1 month drop in the history of the data series, right? Now, it's not forever. It goes back to like 2013, but it's literally the only like other than COVID, there's never been anything even close to that in a 1 month drop. So the point of this chart is that if you put yourself in the survey and you expect your income to grow more slowly, you know, by the biggest drop in the history of the series, and you're at the same time looking at inflation and expecting it to stay at 5%, which is, more than double what the Fed wants it to be. So you're a human being. You got a family to feed, you got a job, and you're saying, I expect my income to grow more slowly and I expect inflation to continue higher. Does that encourage you to spend a lot of money right now?
it does not.
No, it makes you want to save. It means you're going to tighten the belt a little bit and say, should I eat chicken instead of steak tonight? Should I watch a movie at home instead of go out? Should I walk to the store or ride my bike instead of put gas in the car. I mean, you're going to be looking for any way you can to reduce expenditures so that, the future is so you don't starve to death in the future. I mean, to be extreme. And I'm glad but surprised that we haven't heard more stories about people literally starving to death. I mean, it's a real problem out there for a lot of people, and I feel awful about it.
Yep. And then, that turns over to inflation right now, which Shane, you're saying, here's our month over month consumer prices ticking up. And then year over year, it's, excuse me, going down a little bit, but slowly. We went from 5.7 to 5.6. And it doesn't really matter the rate of change as much as the fact that if you got inflation 5%, anywhere around there, that's not helping anybody.
No, it's ridiculous. I mean, it's 5% annual inflation. This 5.6% annual inflation. I, People can't handle that. That is not price stability. And I mean, and it's accelerating. Like you look internally at the month over month numbers. I mean, zero point 0.5 month over month leads to a 6% rate annualized, right? If it was 5% every single month for 12 months, you'd be at 6% for the year, not 5.6. So that's what I mean when I say accelerating. The only other, like, this is the highest month over month since June, which was 1.2%. You can't really see it in that blue bar there, but um, I mean, for inflation to be at 2%, let's see, what do you need? I can't find my calculator. Um, where did it go? There we go. So 2 divided by 12. You need inflation to be at 1.6% month over month to get to a 2% annualized inflation rate. So zero point 0.5 is literally, 4 times higher than what it needs to be. Uh, it's not good. And in the box on the bottom left there, you can see energy prices rose 8.7%, while food costs went up 10.1%. That's year over year. The index for meats, poultry, fish, increased 0.7, but eggs rose 8.5%. Does nobody eat eggs? I mean, pretty much everybody eats eggs.
Yeah.
Cereal was up 1% month over month. Not half a percent, but 1%. The food at home index rose 11.3% over the past year. So just not going out to eat isn't saving you any money. Cereals and bakery products, we got 15.6%. Shelter is up almost 8% year over year. So, I mean, these are all real things that real people are struggling with, and the market just wants to grind higher. I don't understand why. It just doesn't make any sense. And the Fed has to see this, and they have to know that they haven't done anything to combat inflation. I mean, food at home is going up 11.3% a year. These guys should have hiked rates by 3 or 4% in one meeting, not this 50 basis point, 75 basis point. Now we're down to 25 basis points, and inflation seems to be reaccelerating, which is why they're now talking about going back to 50 basis points. Meanwhile, the market's out here talking about how they're going to cut rates. It's
Yeah.
not happening. They're not going to cut rates. It is not going to happen. If anything, the Fed should be like, they should feel like they just got slapped in the face by the market over the past month, and they should come out and do something crazy, like raise rates by 2 or 3% in their upcoming. They won't do it. I'm not saying that they will. They won't. They should, and that would really help people who are struggling to put food on the table for their families. Screw the market, man. People who own stocks will be fine. It's
Yeah.
the people who don't participate in the gains of the stock market that are getting smoked in this economy, and somebody should be doing something to help them.
Yeah. So we'll see what happens there. But, there is the lag effect. It takes time for those rates to work through. But really, we're only back to what it normally should have been. Going at 0% as long as we did was just absurd. So,
Yeah. It especially takes a long time when you're barely hiking rates every meeting. I mean,
yeah.
it would happen a lot faster if they'd really get aggressive about it. They haven't been aggressive. They've just been, doing the same old, same old.
Yep. And then here's kind of just a little more on that. Shane, if you want to talk to this.
This is just this morning. This data came out this morning, which sent partly is what sent the market lower, and partly what had was it Mester? I don't know. I can't remember which one of the Fed talking heads was out this morning saying, we should put 50 basis points back on the table. But this is wise because producer prices are going up. This is, you know, producer prices are basically just average changes in prices received by domestic producers for the stuff they produce and sell. And there's just a survey for this comes out every month. You can see that this is accelerating. It's re-accelerating. I mean, we were falling from 1.3%, less than a year ago, down to zero point 0.4, zero point 0.5, zero point 0.3, 0.4, and then zero point 0.2 for a whole bunch of months. And now the past 2 months in a row have ticked up, and now it's ticking up at an accelerating rate. And if the Fed doesn't get out in front of this and convince the market that they mean business, it's just going to keep going up.
Yep. And then here's one, just jobless claims. So ticking up a little bit, but
I mean, this is
it's,
nothing. Raising rates is supposed to cause unemployment to rise. I mean, I realize that's not, you know, like I'm not hoping for people to lose their jobs, but um, until the Fed raises rates by enough and unemployment goes up by enough, and all those people who used to have jobs can't spend, money on discretionary items anymore. They can, they have to dial it back to their needs only. Until this number is like 500,000 jobs, right? Or 1 million jobs. Uh, it's nothing. I mean, under 200,000 new jobless claims every month is not a big deal for our economy with an unemployment rate of 3.4%. This is not even putting a dent in it.
yeah,
So every time this number comes in below 200,000, the Fed looks at or the market looks at it and says, "Wow, the Fed's probably gonna keep hiking rates," and then the market sells off because ultimately we all know that the higher rates go, the lower the market should go. And this right here is green light for the Fed to continue hiking rates and even to get more aggressive. I doubt they will get more aggressive, but they should.
yeah. And this is one too that keeps coming up as well, the Fed's hiking rates, but the job market is robust. So why not be bullish stocks? And I think it's more of just, that lag effect has not hit yet, and this number needs to go up. So we'll see how it plays out, but you would expect this number to be a lot higher. Right now, it's still just not really alarming. Um,
Yep.
so, and then Shane, you picked up this interesting chart. So if you want to talk to this one.
Well, I figured I might as well put something bullish in. Um, I don't know if I wonder if I wonder if people can see if I draw. Can you see that? Did you see that when I just drew, Kyle?
Oh yeah, I do.
Nice. So these little dots, I don't know how I just figured that out. I wish I would have known that a long time ago. All these little dots indicate times when the S&P 500, um, when there were 80% of issues that were going had up volume, and it caveated with 4 months after a low in the market. So by definition, this is only going to show things that are like after a recent low in the market. Um, but you can see that each one of those little red dots that I was talking about, they uh, they precede the market going higher. So it's just something to consider uh, that, if you look down here, 2 months later, 3 months later, 6 months later, 12 months later, there is literally no red in any of these columns. The market was never down 2 months after one of these signals. The market was never down 3 months after one of these signals. Percent positive 100% of the time, right? Um, and this is the median gain. So 12 months later, median gain is 20%. Um, so if you just look at this indicator in a vacuum and it was all the information you had, you would say, well, the market's probably going to go higher for here over at least the next 2 months, 3 months, 6 months, and 12 months. Of course, we're not in a vacuum and every market situation is unique to itself. It's not saying this time it's different. I'm just saying this time is unique. Um, but if you just looked at this, it is one reason to say, well, no matter what I want to say about fundamentals, This is bullish, and this goes all the way back to 1940. It looks 1950. It looks like so. This is a lot of market history saying, there is a reason to look at this from a bullish perspective, and consider putting some money to work in this market. So, just because we're bearish doesn't mean we're sitting 100% in cash, not for our clients and not in our personal accounts. That's not what we mean.
Hmm.
What is this? F. Scott Fitzgerald said the measure of intelligence, first-rate intelligence, is the ability to keep two competing ideas in the head at the same time and function. And so I can be long and bearish at the same time. And so this is a good reason to be putting money to work in a market like this. I mean, despite what I think is going to happen or what might happen, there's always a way that I could be wrong, and I'm wrong pretty frequently.
Yep.
Idea
So,
is to make as much as you can when you're right and lose as little as you need to when you're wrong.
yep, all about risk reward. So when you have a stat like this on your side, not a bad place to put a little money to work. And, we've mentioned it before, but if you're 100% cash, by the time you decide it's time to get in, you'll probably chase the market. And when you get in is when it'll pull back. And now there's a lot of downside ahead. So always good to keep that in mind. You can always allocate some cash. So, and then here's the dumb money, smart money index. And Shane, I mean, we're getting close to kind of an all-time high, other than I guess it'd be what towards the end of COVID, 2020, September.
Yeah, I mean the smart money, dumb money indicator did not work back in 2021 because the Fed was just pumping money into the market and keeping money artificially cheap and rates artificially low and handing out money to people. I think it was a weird time where the dumb money, um, in this case the red line over there. Um, well, let's see if I can get a new how do I sorry, now I'm messing around with these drawings to see how I can get them. But this whole area back here was like when the Fed was, just constantly buying bonds and keeping rates low, and the government was sending stimulus checks to people. The market just kept rallying, the entire time. That is abnormal. That's not normally what happens. Normally what happens when you see dumb money get above a certain level is that the market goes down. So like here and here, market kind of came down from there. When dumb money got to a high, market got to a high. When dumb money got over zero point 0.7, market got to a high. And here, well, it tried to go down, and here, trying to go down. But we're kind of in I don't know. We're way up there at this point, and I think that I think that this gives me reason to think that the market will come down. And you can see the smart money um, is way down here. I mean, smart money is really not interested in buying, just like the smart money really wasn't interested in buying all of 2021. Everybody was like, "What? This isn't. There's no good reason for this to happen."
Hmm.
Um, so we'll see how it goes from here. But smart money tends to get a little bit more bullish. Like right here, smart money got pretty bullish when the market was at a low during COVID. And so for now, the dumb money is in charge, and you can't ignore it. But I have a feeling it won't last forever, and the market is going to make a turn for the worst. Um, Time will tell. We'll see when it happens.
Yep. And this is another one of those bearish or alarming statistics is household debt. Uh, this going up is not a good thing, never is, and sure looks like it's sloping up right here.
Yeah, I'll tell you. So we're probably just going to go through the next several slides quickly because they basically all say the same thing. But one thing I think is very interesting is credit cards past their pre-pandemic high. You can't see that on this chart. We'll get to it in a second. Um, but this report comes out from the New York Fed. It's a really cool report. If you go to the New York Fed's website, you can sign up for it, um, and they will send you an email every time it comes out. That's what I do. That's how I know when it comes out. It comes out only quarterly, so there's only 4 of them a year. There's a little bit of a lag in the data because I think what's coming out now is for the end of December, right? So it's middle of February, and we're just now getting end of December data. So a lot may have changed in January and the first half of February, but we can see a lot here, and it's the best data we got. So household debt rose overall. Um, let's see, credit card balances up by $61 billion, surpassing the pandemic. Mortgage balances rose, auto loan balances rose, student loan balances rose, and transitioning into delinquency increased. So that's what I want to focus on the most is the transitions into delinquency. Um, that is what I try to keep an eye on to give me an indicator of like how is the economy actually doing. And what you're going to see in the next several slides is that the delinquency rates are like going through the roof. Well, I don't know
Yep.
about through the roof, but they're increasing meaningfully off the lows.
Yeah, they're
And
going up. So,
the reason they're at the lows is because the government printed a bunch of money and sent it to people to pay off their debts during COVID. And, another thing that's like just kind of ridiculous, is student loan debt. The reason it goes down is because people haven't had to make payments on their uh, student loans. So like the level of student loan debt has not gone down here. This is the delinquency rates. The delinquency rates. And you see this red line for student loans just dropping off a cliff. Now, how could that be? How could that be? Well, you might remember that people haven't had to make a payment on the student loans since COVID. So
hmm
you can't be delinquent if you don't even have to make a payment. So
yep.
that's it. It's amazing to me that the number is not at zero. How is it not at zero? I don't understand that, but whatever. It's flat and it's fault. Like if they hadn't waived student loan payments and all these people who can't make a credit card payment and can't make an auto loan payment and are barely making their home equity revolving payments, if they also had to make student loan, the delinquency rates would be, I don't know where they would be, but these are side by side the same thing. One's 30 days and one's 90 days. So these people on the left are 90 days delinquent, and on the right, these people are 30 days or more delinquent. Um, and the 30 day usually what is so if you're going to be 90 days delinquent, you start by being 30 days delinquent,
Yep.
right? So what's going to happen is a lot of these people are going to move into this area, and once they've been 90 days plus delinquent for a while and the company writes off the debt, they assign it to loan losses and it's gone. That actually reduces the number of people who are 90 days plus delinquent. So it's not a perfect measure, but you can see that delinquencies are ticking up, and I don't expect that to change with rates going higher and inflation not coming down fast enough. It could very, very quickly get back into the 2008 financial crisis type stuff, if you don't get ahead of it. So it could get ugly. And how do you go bankrupt, Kyle? Do you know how you go bankrupt?
Don't make your payments.
Well,
That's one way.
the first way is slowly and then suddenly.
Yep.
That's how you go bankrupt. First slowly and then suddenly. So we'll see what happens, but not looking good.
Not at all. So, and then here's another one. So mortgages, you know, same thing. So T 90 plus days late, ticking up.
Yep, and the
And
people
then
getting to current are ticking down. So people getting current ticking down, and people becoming 90 days plus late ticking higher. Not not ideal.
nope. And then just some other stats, but same concept, delinquency ticking up.
Yep, by age, it just looks terrible. Imagine if there were student loans in here.
hmm
That light blue line for the young people would be going, it would just be exploding higher. It would be exploding. I mean, I don't know how high it would be, but it would be exploding higher. So, yeah, I don't, auto loans looks probably the worst. Auto loans probably the worst, followed by um, credit cards, and then serious delinquency, by age for just overall things doesn't look quite as bad, but auto loans and credit cards look terrible.
They do.
I wouldn't want to be a firm right now. I mean, letting people buy a t-shirt $10 at a pop, like I don't know. That's a bad business to be in. Lending money to young people who have terrible credit scores and can't use a credit card on their own doesn't sound like a very good business to be in this day and age.
it does not. And then here we are, just more credit stats. But, once again, so Shane, looks like you highlighted here. So credit card balance ticking up.
So
Oh,
that's now finally, this is highlighting back on what was on the first page of this report, which is that now we're higher than where we were pre-pandemic. So credit card balances overall um, have finally ticked higher than the pre-pandemic high. And I mean, by a lot, the credit limit has ticked higher. So what trips me out is that companies that lend, that extend credit have extended more than people have borrowed, which is a trip to me. I mean, so there's probably still a little bit of room to borrow for a lot of these people. So I would expect this to tick higher. I would expect delinquencies to tick higher. I expect rates to tick higher. And I expect all that to be bad for the economy and bad for the stock market. It's just a matter of time before it plays out. So um, I'm not optimistic.
and I'm not either, especially after walking through these stats. So the charts get me excited. I'm bullish. And then I see this stuff does not make me bullish long term. So,
Back to reality.
yeah. And, here's a cartoon from Hedgeye. They do a great job with these. I'm always impressed. But, this one, pretty self-explanatory, but
Preparing for the
good.
soft landing, right? The soft landing where the Fed can hike rates and bring down inflation without causing a recession. Yep. So smooth sailing for now, right into the mouth of the bear.
Yep. And then, from our folks over at Babylon B, this one, it really ties back to the credit card things. I thought it was pretty funny, but the truth is, credit card balances, a lot of times, they come from Arby's, Starbucks, all those small purchases, they add up. So I thought this was a good one.
Yeah, I mean, if all you can afford is Arby's for your 3 meals a day, that sucks. I feel bad that that's the case, but sometimes going out and getting your food through a window, you can maybe get the most calories for your dollar because you can't buy eggs and take them home. You can't buy fruit and take it home. You can't buy milk and take it home. All that stuff is too expensive. You got to get it from McDonald's or Arby's or through some type of window. Um, and it's a trip to me that like some of the poorest families can more easily feed their family through a window of just food that's terrible for you that causes health problems later. Um, they can more easily do that in some cases than they can actually go to the grocery store right now and get the ingredients to cook a decent meal at home. And it's shameful. Our country should absolutely be ashamed of itself for creating this situation. And I wish that they would just abolish the Federal Reserve and get them out of our economy and stop acting like these people know better than the market what price of money should be. That's
Yeah.
ridiculous.
So hopefully we'll have some good news ahead. But right now, that's the hard reality is that things are expensive, credit card balances are up, and it's a tough market. So hopefully we'll have some good news here months from now. I don't know.
Hope is not
But
a strategy, Kyle, but I love your optimism.
yep. You always I always got to, half glass full. That's
There you
that's
go.
me. So
Yeah, no, hey man, I don't want to be a perma bear. I don't want to just be pounding the table that everything's awful. It's a beautiful world that we live in, and I think you can find a silver lining. I'm happy to be alive, but I just wish the government would quit messing with things and stop manipulating things and let the market just do what it does. The business cycle is a beautiful thing. Capitalism worked for hundreds of years without a Fed interfering with prices. And yeah, there were booms and busts, and yeah, companies went bankrupt, and yes, certain people take advantage of things. But I mean, what's the difference? Are you really helping right now? I mean, look at the current state of the world. I mean, what? How are you helping? Tell me.
yeah,
Printing all that money and giving it away are exactly what caused inflation to be what it is. So anyway, yeah, glass half full, buddy.
yep. So well, Shane, until next time, good luck out there. I know you got a lot going on, but thanks for your time, and I'll see you next Thursday.
Yeah, Elevate's hiring, by the way. If you're in the
Uh,
financial services industry and you want a job, give us a shout.
yeah, check it out. We're on LinkedIn, so all of us have it linked to our profile. If you go on there, check it out and let us know if you have any interest.
All right, later,
So
man.
later.